We are 30 minutes away from the start of trading after a 55th record on the S&P 500. I'm Matt Miller.
I'm Shonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, we're wooing the bargain hunters out there in the market. Dollar Tree is seeing better sales in the third quarter, but Foot Locker fails to keep pace with frugal shoppers.
And GM's China troubles. The car maker takes a $5 billion hit because of its troubled operations in the world's largest car market.
And finally, do we have a winner in the Battle of the Bulge? Eli Lilly's weight loss drug Zepbound outperforming its rival Wegovy in the first head-to-head trial of the two blockbusters. We'll speak to Lilly's chief scientific officer next hour. Before we get there, let's take a look at where these markets are trading. We have a pre-market rally on our hands. The S&P 500 up by about 0.4%. Of course, ADP did miss slightly. We hear from Jerome Powell later today, so a lot of catalysts to keep an eye on. It's all adding up to a higher big tech index pre-market. The Nasdaq 100 up about 0.8%. And then you take a look at this sell-off underway in the bond market. The 10-year Treasury yield higher by about 4 basis points right now, Matt, up to about 4.27%.
By the way, so far we're looking at gains of 26.84%.
Oh my God.
On the S&P 500. If we overcome 26.89%, this would be the best year that we've had in 6.
I'm going to go write all of this down.
Yeah.
I'm not. I'm just going to check that on the terminal later, Matt. Anyways, we're looking at some stocks this morning moving pre-market. Like Katie was talking about, Eli Lilly now up 1.6% pre-market. Shares are higher after its weight loss drug outperformed Novo Nordisk's in a head-to-head trial that was led by Lilly. Of course, we have that big interview later in the show brought by Katie. It's good stuff. We have Salesforce.com also just soaring pre-market after results raised hopes about the company's AI strategy. Big day for AI. We're looking at Foot Locker also. Already a tough year, but even tougher today, much tougher. You're seeing it down almost 18%. It cut its full-year sales and profit forecast. I would take a look at Nike throughout the day as well, big supplier, and you are seeing really a weaker optimism among shoppers, Matt.
All right, I want to just bring you some breaking news on a shooting here in Midtown New York. The CEO of United Healthcare, Brian Thompson, was fatally shot here in Midtown. We're just getting headlines across the wire, not to be confused with the United Healthcare Group, or United Health Group, I should say, UNH Equity CEO Andrew Whitty. But United Healthcare CEO Brian Thompson has been shot here in Midtown Manhattan, and we'll give you more on that story as we get it. I also want to get over to Michael McKee right now because he's sitting down upstairs here at 731 Lex with St. Louis Fed President Alberto Musalem and the Bloomberg GIC Monetary Policy Symposium kicking off with the two. Let's listen in.
Forecast between now and the time that resolution of that full uncertainty is achieved, which could take a year or two. So we're going to gradually absorb information as it is available to us and incorporate new policies into our forecasts. Once the contours of those policies are understood and we can quantify things and understand how they would affect the dual mandate.
Well, are you going to say you're data dependent in terms of what the new fiscal policies might be, or are you going to be able to make estimates of what's going to happen and react on those?
So my staff is already making, doing exercises of, for different tariff configurations, how might that affect the economy? For different fiscal configurations, how might that affect the economy? So we're beginning to exercise our muscle memory or forecasting muscle in terms of understanding, so that when you get the final configuration of these policies, we can then go back to all these exercises that we are beginning to do and understand, okay, given what we have to take those as inputs. So take those policies as inputs and then go and analyze how that could possibly affect our dual mandate goals.
Have any of your scenarios produced positive outcomes for the economy?
the textbook, would tell you that, tariffs would tend to increase the price level and tend to potentially decrease demand, decrease imports, and possibly increase domestic supply. So that's the textbook, that's exercise. We have just been through a large immigration surge, and so we just observed how an economy reacts to a large immigration surge. So you could imagine that if immigration policy were changed, you could observe the opposite, right? Or something goes in the opposite direction, not of the same magnitude, but maybe it goes in the opposite direction. So, and there's a lot of literature and a lot of experience with fiscal multipliers on taxes and on revenues, and so there's a good understanding of that. But that's the framework. But the inputs that we need into that framework are unknown, and we have to take those as given. We can't pass judgment on this. We just have to take them as given. We can't comment on them, and then we incorporate them into our view of the world, and then we will configure monetary policy as needed.
You mentioned we might be getting close to a pause, in part because you want to keep the pressure on inflation from more restrictive policy. Would you also consider a pause to consider fiscal policy, an unknown, unclear situation, so maybe we better sit back at a meeting or two?
So if you heard my remarks, I didn't mention fiscal policy at all, right? So my current assessment that the time may be coming when it may be appropriate to consider slowing or pausing is based on how we observe the economy today. And so going forward, you have to observe the economy in the future. And, there are a few agents in the economy that are very important. So consumers are very important. Companies who do investment are very important. Net exports are very important. And the government is very important. So if the government is changing its configuration of taxes or revenues, that's going to affect the economy like other sectors of the economy. And at that point, that would be considered.
You mentioned your idea of where neutral is informed by policy rules. And I'm wondering what your sort of monetary policy vision is. Do you rely more on rules or discretion? And you're going to be talking to a lot of people who have opinions about that.
It's a great question. So rules are just a tool to look at and to take some input from. But there are many, many other sources of information that we and I take in to make decisions. So it's about discretion, not about rules. But the rules are helpful because they give you, some reference point to look at. Now, I did not say that the rules suggest policy is at neutral. So those were your words, not my words. What I did say is there's uncertainty about where the neutral rate is. Plausible ranges could be, in nominal terms, for the Fed funds rate could be between 3% and 4%. Seems like a plausible range. Some folks think it's closer to 3%. Some folks think it's closer to 4%. The committee's last SEP in September suggests it's closer to 3% in nominal terms. So depending on where you think the neutral rate is, what policy rules tell you is, given where the economy is, on top of where the neutral rate is, where should the policy rate be today? And that's why today the policy rate is above its neutral rate because inflation is still above 2%.
Well, it sounds like you're more concerned about inflation than you are about recession at this point, and you are looking at a policy rate staying above neutral for perhaps longer than some people, some other your colleagues or other people anticipate?
What I will say is, when I observe my colleagues, I'm certainly very committed to bringing inflation back down to 2%, and I know my colleagues are also very committed to getting the job done. So I would not say that I'm more committed than my colleagues, if that's what you're trying to imply. I think we're all equally committed to bringing inflation back down to 2%. At present, it seems to me like inflation has been higher than I would have liked, and I think that some of my colleagues would have liked. And the concern about the labor market that was there during the summer has ebbed. And so right now we have, at least the way I see it, is less concern about the labor market having a disorderly adjustment. And to my eye, the risk that inflation stays closer to 3% than coming down to 2% seems to have risen. Not because of the future, but because of how we see the economy today.
We'll get a little more wonky here. We do appear, as you suggested, maybe is happening, that we might be stalling out a little above 2%. What has slowed progress at this point?
So, as I said in my remarks, if you get inside the inflation indices, we've seen a lot of progress on goods inflation, core goods and non-core goods. We've seen a lot of progress on energy inflation, which indirectly feeds into core, not directly, but indirectly through the production process. We've seen some progress on some services, but when you look at services in their totality, they're still running high and higher than they did, pre-pandemic. And housing services inflation has been sticky, but that is always very lagged. As, you know the data very well, and that takes between the time that market rents for new leases began to decline and the time that housing services inflation, as they're measured in the indices, actually declines. It could be a period of 2 years. So the good news is that housing rents for new leases are declining, and that would suggest that overall housing inflation should decline over time.
Well, as you look at inflation, if you take housing out, you're pretty much there at 2%. Some people think you will go below it on a PCE basis. So are you looking through housing now as you consider where the economy is and how restrictive you are?
I prefer not to be selective when I look at the different inflation indices. So I include housing in my understanding of indices.
What about the data itself? We saw JOLTS come out yesterday. A lot of your colleagues have suggested maybe they're giving us a misleading impression because the response rate in part is so low. Response rates for all surveys have gone down. How much confidence do you have that you're getting a true picture of the economy? And I ask that with essentially the forecast ahead for jobs on Friday. We've had some significant revisions to the jobs reports. Are you concerned that you have accurate enough information to feel confident in whatever decisions you make?
This is a great question, Mike. So there's always there's a lot of people in the room here that are observers of data, and former policymakers, and it's just something you have to live with. Is the data is uncertain. I once had a finance minister from a country that's dear to my heart tell me, Alberto, you got to understand that in most places the future is uncertain. In our country, the past is uncertain. So meaning you have to live with data revisions. You have to live with what you thought was true at the time may turn out to be revised after the fact. And we understand that. We understand that when you see a number, you take it as is, but you can't be 100% sure that that is the final number. So that's just a fact of life. You have to live with it. You are correct that a lot of the data we looked at, particularly in the labor market side, the response rates have been declining. Also, there's an issue of the very important immigration surge that has happened. Has led to divergence between the establishment survey and the household survey of the labor market, and that's a little harder to reconcile nowadays than it was previously. So, I take every data and mentally I understand that there's a confidence interval I need to put around that data. I don't take it as a true point estimate. I understand there's some uncertainty.
Do you think that because you have to put out an SEP under those circumstances, and of course now with December...
All right, that was Bloomberg's Mike McKee speaking with St. Louis Fed President Alberto Musalem. You can continue to follow that conversation by typing LiveGo into your Bloomberg terminal. But we do want to go back to that news that broke right before we went on to air, and that is that United Healthcare CEO Brian Thompson was fatally shot outside of the New York Hilton Midtown in Manhattan this morning. United Healthcare is United Health Group's insurance division, and we don't know very much so far, you guys, but the New York Police Department is saying that, again, Brian Thompson, he is the CEO of United Health's insurance division, was fatally shot just this morning.
Yeah, outside of his investor day, and obviously that investor day has now been canceled. I think it is an important distinction to make that this was the insurance division of United Health Group, so it wasn't Andrew Whitty. Obviously, it's horrible news no matter who it is, especially the idea that it was here in Midtown Manhattan is absolutely chilling ahead of his investor day. Brian Thompson was the CEO of United Health Care, the insurance division of United Health Group.
Not surprisingly, United Health has halted the Investor Day event. Remember, this is a very dense area in Manhattan, in Midtown Manhattan. To your point, we don't know, Katie, a lot of information yet, including about the shooter and the motive behind what had happened, but certainly very sad.
So we will continue to follow this story and bring you more details as we have them. And meanwhile, we are about 15 minutes away from the market open. You can see right now that futures are higher on the S&P 500, up by about 0.4%. Big tech won better. The NASDAQ 100 up about 0.8%. The small caps, too, seeing green before the bells ring. Now, coming up, we'll speak to Jack Janasiewicz. He is portfolio manager and lead portfolio strategist at Natixis Investment Managers. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Back to the news that broke right as we went on air today. United Healthcare CEO Brian Thompson was fatally shot outside the New York Hilton in Midtown Manhattan this morning. United Healthcare is United Health Group's insurance division. Thompson was shot outside the New York Hilton, where the company was hosting an investor day, and that investor day, I think, obviously has now been paused, if not completely canceled. We'll bring you more details on that story as we get them. In France, the President Emmanuel Macron is asking lawmakers to reject a no-confidence vote that would topple the government. Far-right leader Marine Le Pen and her National Rally Party have vowed to support the motion submitted by a left-wing coalition. Lawmakers debate and vote on the motion in less than an hour from now. We don't know how long the vote will take, but we'll bring you those results as soon as we get them as well. Here in the U.S., President-elect Donald Trump is reportedly considering Florida Governor Ron DeSantis as a possible replacement for Pete Hegseth to run the Pentagon. Trump allies are said to wonder whether Hegseth will survive further scrutiny of his personal life after allegations of rape and an alleged 2018 email from his mom accusing him of a pattern of abuse towards women. And Shonali, there's a lot going on. We're going to keep you apprised of all these stories as we get news across the wire.
Absolutely. For now, we turn back to the markets. Joining us now to talk about it, Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers. You know, in just a couple days, we will be exactly one month from those election results. And my question becomes then, and by the way, that's the same day we get the jobs report as well. So do you switch gears? Do you make this about the politics, or do you make the way you're thinking about your next investment about the macro?
I think you start out by thinking the macro, because at this point, you still have quite a few tailwinds, right? And I think the big one is simply, listen, the Fed is actually in easing mode. We can argue about how many rate cuts we'll be getting between now and the end of 2025, but you know, you're still getting an easy Fed, and the economy's still holding up fine. The jobs market's still holding up fine. That's the underlying theme. Switching gears and talking about the Trump policies, if you will, you need more details on that, and it's going to take some time for it to work its way through the system. So it's sort of maybe in steps. I think the base case is the fundamental story, and then as we start to get more details on policy, we shift accordingly.
So let's build on that, this idea of an easy Fed, because we actually just heard from St. Louis Fed President Alberto Musalem saying that the time may be near to slow or pause rate cuts. And I wonder just how much optimism is baked in that we are just at the start of an easing cycle.
Yeah, and I think counter that with comments that we had from Williams and Mary Daly, from that and Waller actually as well. all three of them are somewhat hinting at potential cut for this December meeting. But I think the market's already sort of pricing in maybe an every other going forward and looking at an incremental 2 or 3 for the rest of next year, which I think is probably right. I think from this perspective, though, rates are still restrictive. There's room for them to ease at the margin. Maybe don't have to go 5 or 6 times, but we're still at a restrictive level, and I think that is the underlying narrative here.
But how much further can we go? I mean, the market's pricing in, I think, a 4% terminal rate, and the dot plot, at least the last one we got, is for 3%. So that's a pretty big dispersion.
Yeah, and I wouldn't be shocked when we get that new SEP out. You're going to see some of those dots drift higher. So, I think the market's probably right smack dab where they should be right now in terms of expecting rate cuts going forward. And then it's going to go back to data dependency. If things start to slow, I think that Powell put kicks back in, and you're going to see the potential for maybe more pricing of rate cuts going forward. But if the data remains firm, we probably still stay on this holding pattern here.
What does it mean for the mix of stocks and bonds in your portfolio? Because it's interesting, the 10-year, we've been watching it so closely. Yesterday, we watched Katie point out less than 420 on the 10-year. You're now back to 426. The volatility is incredible. And if you believe you're heading lower, then do you buy more? Because you think that maybe, the S&P valuations topped out, room to run the bond market.
Yeah, but I think from a bond market perspective, you're probably going to be earning your yield. And maybe you get marginal appreciation with regard to maybe a tighter level on spread. But for the most part, I think we're range bound, and you should be expecting to basically earn your carry in the fixed income market. Plain and simple.
That's interesting. And when you talk about the fixed income market, are we talking about treasuries, or are you looking towards corporate credit here?
So you need to put this in the context of a traditional 60-40 portfolio, right? And I still think we have a bullish outlook for equities going forward. So I'd rather spend some of that risk budget on the equity side of the equation. So, with corporate spreads as tight as they are, maybe not a ton of room for spread compression. But the flip side to that is I might move a little bit away from that, own treasuries, because I want to take more risk on the equity side, and I want some of that equity risk offset, and I need that through the treasury side of the equation.
What are the warning signs that you look for, Jack, in a frothy market? Because, over the last 6 years, total return is more than triple on the S&P, right? And we're looking at record tights here. We keep getting reports that U.S. households, as well as institutions and international, are all, more equitied up than they've ever been before. And we don't see a ton of leverage in the system, but what do we look for?
And I think part of that is really more of an art than a science, so to speak. And I know we spend a lot of time focusing on risk appetite, and there's all sorts of metrics that we pay attention to, whether it be sentiment surveys, flow data, and just conversations with our clients. And I would say right now, what would make us more concerned about that risk appetite backdrop would be clients asking us what else should they be buying. We're not getting those kind of questions right now. We're still seeing people piling into fixed income, short-term treasury bills, money market funds, because they're still getting a pretty decent yield. And so from that perspective, I don't think we're at that stretch point where I'd be a little bit concerned where risk appetite has run so far that maybe it's time to start pulling in the reins a bit.
What's the case for just looking at the macro? Because you see these individual corporate stories, and you see a ton of retailers really muddling through this environment. Many citing a weaker consumer just this morning. Yep. Look at the hit Foot Locker's taking. And so when you see those types of numbers come out, do you consider it dispersion, or do you consider it a sign of trouble?
I think this is the case that's been going on for quite some time now. It's the bifurcated consumer, right? You've seen sort of the middle and upper echelon income cohorts still doing quite well. The bottom cohort's really getting squeezed. And the one thing we remind our clients here is simply, that lower income cohort doesn't account for a ton of that total consumption out there. If you look at sort of that maybe the 20 percentile or lower, it counts for less than 10% of total personal consumption expenditures. And what's the big driver for the U.S. economy? Consumption. So when you have 80% of the consumers still in pretty good shape, it's tough to really get too concerned about this right now.
All right, well, that's a good place to leave it. Jack, it's great to see you again. That is Janice Siewitz of Natistics. Meanwhile, let's get a check on these futures right now. Just minutes away from the opening bell, you can see we have a rally on our hands. The S&P 500 up 0.3%. Big tech leading the charge right now, and the small caps also rallying as well. Your Russell 2000 up about 0.2%. We'll discuss all of the market moves at the opening bell with Sarah Hunt. She is Alpine Saxon Woods Chief Market Strategist. This is Bloomberg.
All right, after 55 records on the S&P 500, we're set up for yet another one, and this year could now eclipse 2021 as the best year in 6. We're looking at more than 26.8% gains on the benchmark index. You can see futures are up 0.3%. NASDAQ futures are up double that right now, and Russell 2000 futures are trailing. In terms of the opening bell, you hear it down in the New York Stock Exchange, Ally ringing the bell there, and at the NASDAQ market site, you've got GoFundMe. Apparently, there's like a Giving Tuesday thing, which was yesterday, and it's raised billions of dollars for charity. I'm finding out about all these new special days that we have, Katie. What I do know is it was a record day for the stock exchange, and we're looking at possibly another one today. What do you see in terms of the major averages?
At least where it stands right now, we would close at a record high. We are above 6,000 and then some on the S&P 500, currently higher by about 0.3%, just 35 seconds into trading. But it's big tech that's leading the way right now. The Nasdaq 100 up about 0.7%. The small caps underperforming a little bit today. We know that that has been the outperformer. It'll be interesting, of course, to see the reaction to Jerome Powell coming up this afternoon ahead of Friday's jobs report. But this is where we stand as of this moment. Let's look under the hood right now and talk about Eli Lilly, higher right now after its weight loss drug Zepbound outperformed Novo Nordisk's Wegovy in a head-to-head trial. We'll speak with Eli Lilly's chief scientific officer in the next hour, and at least right now, shares up about 1%, Shanali.
I'm watching Salesforce here, Katie, because you're seeing it soar about 10% this morning. It is pairing gains. It was up more. Results beat estimates and raised hopes about the company's AI strategy. The share is still up more than 9% as the market opens.
All right, we're watching, obviously, Salesforce and the push that gives to the NASDAQ, but I'm watching General Motors getting a $5 billion hit from charges, write-downs due to its struggling operations in China. It had valued the business at $6.5 billion, and now substantially less. Let's take a closer look at some of the companies reporting results this morning. For that, we go over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Yeah, Matt, let's take a look at a couple of the retailers. Really a tale of two stories here, or two retailers. Dollar Tree up about 3.1% off the pre-market highs, but nonetheless, they beat and boosted. Foot Locker, on the other hand, you can see plunging down 18.4%. They missed and cut the view. So let's dig in a little bit deeper to what investors like and don't like. Relative to Dollar Tree, this company's really been having a tough time this year. You can see all of these not so great negative comp sales where they've missed. But here we have up 1.8% in the quarter that was. Again, they beat on both the top and the bottom line. In addition, they've also boosted the view. This stock down into today about 49% on the year, 6% bearish short interest. So that's why we have the bullish reaction. Expectations were low and they beat. As for Foot Locker, on the other hand, there's also a bearish short interest on this stock. The stock down less on the year, down 22%. But relative to the guide, while this looks positive because they're coming out of negative territory for comp sales, the 2025 overall estimate is lower than what they had been looking at, up 1% to 3%, and the street estimate of up 1.64%. And it seems as though the holiday is really hurting a little bit. And from a feet on the street perspective, Katie, I was out shopping yesterday in Westchester, and I can confirm I was really one of the only people out in a couple different stores. And I was thinking to myself, is this the holiday season? It seems as though Foot Locker's maybe seeing something similar with the outlook that they're providing.
Yeah, some good on-the-ground reporting there.
Where, though? Westchester's so big. Where were you, Abigail?
Well, to be specific, I was in Scarsdale at Saks Fifth Off Avenue, empty. It's a massive store. I was also in Fox's, empty. Barnes & Noble. Actually, there's a little action in Barnes & Noble, so books. That's what people want this holiday.
People want books, the gift of knowledge.
Prove their minds.
Yeah.
If you got a book in you, you need to get it out, you know?
That's true.
If you have a novel in there somewhere, Katie.
Yeah, you know, you just got to write it down. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Sarah Hunt. She is Alpine Saxon Woods Chief Market Strategist, joining us on set. Great to see you in person, Sarah.
Good to be here.
So I am stuck on this comment from Alberto Musalem. Of course, he is the St. Louis Fed president, speaking earlier today, talking about it may be the time, or the time may be near, rather, to slow or to pause rate cuts. And the reason he gave was that we have higher than desired inflation. And we haven't heard a lot of Fed speakers acknowledge that it seems like we've stalled out when it comes to progress with inflation. Going into 2025, how big of a risk is it the potential for a reacceleration of inflation?
I think that is going to show up in a lot of year-forward strategy outlooks, because I think that there are obviously some forces that could be inflationary. The question is, how much do we get of the tariffs that might come in? How much do we get of immigration reform? How much of the things that people are worried about that could do that? And then what else can come up? I mean, the South Korea situation, I think, took everybody by surprise. So there's obviously things on the global stage that can come up. And so I think that one of the things that people are going to be looking at is, are we really seeing a kind of quiet inflation, or is there some coming back of that? Because that will really, I think, spook markets as well as potentially the Fed.
But if you do see inflation, I mean, stocks are a great thing to own in that situation, right? Especially if you have deregulation, lower taxes, and we're light on tariffs and deportations, right?
There, you can see a lot of different scenarios, which is why I think it's going to be interesting to see what everybody's look ahead is for 2025. Because from our perspective, the probability scenarios are that there's a lot of different places we could go. And I think that it could be good for stocks, but there's also rates coming down are good, right? So if that looks like that tension is going to change, then higher rates may be more problematic. And that might be difficult given that where valuations are. If we were starting at low valuations, it wouldn't really be an issue. But we're starting from valuations that are just making daily highs records. So I think that's some of the tension that we're going to have going into 2025.
You know, I think I'm in the group a little bit of the worry wart here, because you're sitting here near record highs in the stock market, but you see signs of the consumer cracking in certain areas, and that higher inflation or not reasonable inflation is still being cited by a lot of executives as one reason why. At what point does that spill over?
It starts to spill over when earnings start to be affected in a really negative way. And right now you're looking at things like one-offs. And people look at Foot Locker and they'll look at individual stories and they'll say, there's a reason that this story is having a problem, and I can't extrapolate it to the entire situation. Now, the fact that Dollar Tree had good numbers when some of the lower-end consumer has been really struggling, I think that a little bit of a turn, that gives people confidence that it's all idiosyncratic as opposed to problematic on a larger scale. But there's definitely a bifurcation on the earnings side, and where that spending goes has obviously been bifurcated for some time, and that's not really changing.
And by the way, Dollar Tree, the chart looks very bad. I mean,
Foot Locker is just as bad now almost. It's down 35% this year, more.
Dollar Tree is down 50% year to date, and, you know, it's not been good over the last 5 years.
Yeah, it feels like there's a lot of have and have-nots when it comes to the retail, the apparel categories. And how do you approach that from a portfolio construction sort of perspective here? I mean, do you play in that space, or do you try to avoid some of those sectors that are more oriented towards the consumer?
Well, I think that since for the last couple of years, you've seen the lower end consumer have a harder and harder time, and inflation certainly made that worse. So you try to stay away from places where the main customer is your lower end consumer, either on the credit side or on the retail side or wherever you're looking. But you've also noticed that in some cases you have a land of different worlds for some of the very luxury retail stuff, because you've had more trouble in Gucci and better stories for LVMH. It is not a clear picture, so what you're trying to go for is areas where you see that there is some continuity of growth that ends up being a lot of technology on the retail side, but it's also, you can see that some brands have got a situation where they're better off than they were, but even some of that has backed off from the highs.
Is there a stock that you love that you get up in the morning and you're like, yes, I'm going to talk about this on Bloomberg? Or is there one that you tell people at, you know, cocktail parties, stay away from that stock?
Well, what's interesting is you've seen a re-rating in the pipe stocks. The pipeline stocks. I was actually away for a couple of weeks, so I wasn't watching every day, which is an unusual situation.
Good for you.
I know, it was great. But I came back and I looked at all the pipeline stocks and I was like, wow, all these stocks have had a little bit of a re-rating after being essentially dead in the water for quite some time. And I think people are looking at energy infrastructure, and they're looking at infrastructure. You saw natural gas prices start to soar in Europe when you start to see some of the deliverability issues and some of the weather issues. And I think that there is a deeper understanding that the energy infrastructure has a value and is going to continue to have a value regardless of how we try to change our carbon chain.
You know, speaking of stocks that people love right now, I'm taking a look at Marvell Technologies. Of course, very, very promising outlook that they've given investors, to the point that you now have the stock at a new record high. It's up another, it looks like 19% right now. I've just kind of been watching it on my screen. You also have Salesforce up very meaningfully today. What does this say to you about the AI trade?
It continues, right? There was a period of time where people thought, well, maybe this is more hype than reality, and maybe this is something that we really have to start to see come through the numbers. It's coming through the numbers. That is something that is going to help keep this market in good shape, because the big question was, we have this fantastic story and you can spin a great tale on it, but if I'm not making more money, or if it's not making me more productive, or in the end, if the promise isn't actually coming through to numbers, then it's not going to continue to hold the market higher. The fact that you're starting to see this come through is showing you that. And I think Salesforce was punished pretty badly at one point for not having an AI story. So the fact that they can turn that around and have one now tells you that this is still a big driver for the markets.
All right, Sarah, got to leave it there. Really appreciate you coming into studio and taking the time. That is Sarah Hunt of Alpine Saxon Woods. This is Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on stocks about 13 minutes into the session. You can see the S&P 500 climbing right now, up about 0.3%. Big tech is your leader with the NASDAQ 100 up about 0.6%. And momentum building behind the small caps just in the last couple of minutes. Now up 0.4% on the Russell 2000. We'll continue to keep an eye on the big benchmarks. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC is upgrading Merck to a buy. The analyst says that current valuation leaves a significant margin of safety in the stock. Next up, we have JP Morgan downgrading M&T Bank, saying it's no longer a buy, and also saying that the bank's commercial real estate exposure will remain a headwind and doesn't see any catalyst for continued outperformance. And finally, the sell ratings on Maersk are stacking up. Now, Morgan Stanley giving the global shipper its 10th sell equivalent rating today. The analyst says that negative earnings risk make Maersk a, quote, value trap, and adds that he sees container supply growth outpacing demand, Matt.
All right, let's get back to the news that broke right as we came on air today. United Healthcare CEO Brian Thompson was fatally shot outside the New York Hilton Hotel in Midtown Manhattan this morning. United Healthcare is United Health Group's insurance division. So UNH, their insurance division, the CEO of that unit, not the CEO of United Health, Andrew Whitty. Nonetheless, it's a tragic story. A man who was just about 50 years old. Bloomberg's Katya Porzakansky is here with us, our bureau chief, New York bureau chief. So what do we know, Katya, so far?
So the story is still unfolding, but we have from police sources that the individual, the suspect who has still not been caught, may have been waiting for Brian, who was coming in early to deliver an investor presentation. And he was coming in early, I think, to maybe work on it or something. He was there at 7 o'clock in the morning. The individual seemed to have been waiting for him, shot him in the chest from about 20 feet away, and then ran off through the Ziegfeld pass-through, which, I mean, if for those familiar with New York, with Midtown New York, of the New York Hilton, the Hilton, which is right near the Times Square area, and then the Ziegfeld Ballroom close by. There's a pass-through between the buildings, and so the police are looking for him right now. We expect that we'll have a press conference from either Mayor Adams or the police department soon.
This area in New York is a really dense area, as we had been talking about. It is flat dab in the center of Midtown. It also happened during the company's investor day, as we've been talking about. Executives had continued presentations until 9-10 a.m. pretty recently. What do we know about the area right now and how the company is handling this?
Right now, we haven't heard much from the company other than that they have ended the investor day. We have sent 2 reporters to the scene, and I'm sure we'll have some color from them shortly. We're very curious to see who was there, who saw what, and I'm sure a lot of rattled people. But because it does feel, at least at this stage in the investigation, it feels like a targeted shooting as opposed to random shooting. As grim as that is, it tends to be calming to masses, right? So that it doesn't feel like this is a random shooter that is going around shooting people in Midtown.
Well, Katya, we'll look to you and your team for more updates throughout the day. Like you said, reporters on their way to the scene right now. That is Bloomberg's Katya Porzakansky, and we'll bring you all the latest headlines as we get them. This is Bloomberg. Welcome back to Bloomberg Open Interest. You take a look at stocks right now. We have a rally on our hands right now. If we closed right now, this would be yet another record high for the S&P 500, up by about 0.3%. Your biggest points contributor to the upside is Microsoft, and followed by Amazon. And you can see that reflected in the NASDAQ 100, which is higher by about 0.7%. But keep an eye on the small caps. That rally is building. Of course, we were pretty much unchanged at the open, but just about 20 minutes into the session, the Russell 2000 now higher by about 0.5%, Shanali.
And Katie, it's time now for the Wall Street Beat. Today, we're looking at a Citigroup decision to dismantle its Asia high-touch equity sales trading desk 5 years ago. For more, we are joined by Bloomberg's Sridhar Natarajan. Walk us through exactly what has happened at this trading desk and what it means for their larger strategy to move past regulatory hurdles to really boost this trading desk.
Well, so let's zoom out a little bit and even look at why we care about the Citi equities business and why there is so much focus on it and there is so much angst out there. Citigroup, the company, the stock is up 40% this year, which sounds good, but it is still the worst performing big bank in the United States. When you look at their equities business, there has been a lot of focus there, not just with regards to misbehavior in terms of trades, but also culture questions, harassment allegations, and a lot of other such things that have really put the spotlight on this business. Last year, they made about $4 billion. This year, they're on a track to do a little bit better, but still would likely end up about $2.5 billion behind Bank of America and a country mile behind the top three. So there is clearly a lot of pressure there. This Asia story in particular focuses on what happened when the regulators came in and put down the hammer. They were looking at how the bank's traders were carrying out, trying to drum up business, trying to tell clients that there is indication of interest, that they should sell their stock to them. They will find a market for that. It wasn't always genuine. That clearly is inappropriate behavior, but the traders would tell you that was the culture out there. There was pressure to bring in more revenue. There was a focus on the biggest stocks in Hong Kong and elsewhere in the region, and they had to resort to behavior like that, which then takes us to the bigger question. When things like this happen, when we find misconduct, who is to blame? Is it the line trader, or is the management culture at fault here? And that's something that banks, all big institutions, have always wrestled with. And at least in popular perception, the cynical view has been management always goes scot-free. It's the line trader, it's the pawn that gets dismantled.
Of course. That's how it always happens. Sri, what about on global Wall Street, when you're a trader, a successful trader, maybe at a different bank, do you want to go to Citi? Is that a place that they want to go? Like, do headhunters bring people there, or would they rather go to other places?
Depends on your attitude. Do you run into a burning building or not? Because clearly there is trouble there. Clearly, they've fallen behind their biggest competitors and their rivals. But it also means that you're buying low and have the option to sell high. So you could go in there and turn around the business. So if you're a management leader, that option exists. There's no indication, to be clear, that Jane Fraser is saying we need to dismantle the existing Citi Equities leadership. But I'm sure they're certainly feeling the pressure that they need to improve the business and get beyond some of these uncomfortable headlines that have been focused on this equity.
And dispel the image of, like, we throw our traders under the bus when bad things happen.
Dispel the image that nothing is working in that business right now. And it's not just an equities problem. Across the Citi operational structure, there seem to be a lot of issues. And that's why Jane Fraser, who's about to enter year 4 as CEO, is facing the heat.
Well, let's talk about an unrelated but another uncomfortable headline. This from a Bloomberg News story that Citi faces $26 million in losses on an Australian block trade. What do we know about what went wrong?
Look, when you're running a risk business, anytime you're standing in between sellers and buyers of stock, there will always be some risk. The question is, how well do you manage it every day and through the quarter and through the year? If you look at someone like Goldman Sachs, one of the best performing equity trading houses, it's not like they don't have down days. In fact, Goldman Sachs on occasions during the quarter will have days when they've lost more than $50 million, but they more than compensate for it with up days, which are significantly higher and significantly more voluminous. For someone like Citigroup, it's not really helpful to have headlines like this. It's not really helpful to lose a business like this. And this one's interesting. It's a block trade. They underwrote it at a very tight discount. Clearly, the market did not want to buy it at that level because you're bringing a big slug of stock into the market. They want a bigger discount because the stock is going to go down after the trade is reported. Then they tried to rewrite the deal, gave a wider discount. But by that point, the market's already been spooked. The little slug that they did manage to sell off was below the level where they underwrote it. So they've clearly taken a hit there. They're still stuck with about $1 billion Aussie dollars of stock on that. That could go bad for them. But if the stock were to rebound, they could make up for these losses. But it's not a good image for someone in the business of trying to sell blocks that you don't have a correct sense and grip on where to price the deal.
All right, Citigroup, our focus, and it's just a deep underperformer. Over the past 5 years, the stock is still underwater. It's down today. Shri, thanks so much for talking to us about Citi. General Motors, another stock that's off today after writing down its China business. It's going to take a $5 billion write-down. Some of that money is going to be to close factories. Some of that money is going to be for the reorganization, and some to reduce the value of the equity in joint venture with SAIC in China. This is, I think, a very interesting story because they have been successful in this business in years past, and they do have brands like Buick that are popular in China. They do have models like the Cadillac CT5 that sell well in China, but there's so much uncertainty, right? With Trump coming into office, with Xi maybe reacting against even higher tariffs. Who knows what the future looks like for American companies doing business in the world's largest car market?
Yeah, it's a huge question mark, and it's interesting that they're not walking away. We've seen plenty of automakers close or sell plants and also walk away from similar joint ventures. This is framed as sort of a revamp, so they're still trying. They're still trying to get back to that profitability. It's interesting to see the share reaction. We were down much more significantly on GM, but coming back a bit.
Yeah, that's pretty fascinating to see. Maybe this is not so bad. The interesting thing is, even though you have this initial hit, it doesn't think they need additional capital in a venture that they still want to keep going. But to the point that you're making, if China invests in its own automakers, what place does that make for American automakers that want to pair up and do business there?
Yeah, it's a very good point. There's just too much uncertainty, I think, going forward to keep this business valued at $6.5 billion. So they cut it down significantly, but they still think they can make a profit there. They still think they can turn that business around. We are going to continue talking about car makers. In the next hour, we have the CEO of Lamborghini, the Italian supercar unit of Volkswagen. Stay with us for that. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. You take a look at the market right now. Like Matt said, 30 minutes into the trading day, volume a little bit lighter, but stocks are higher. The S&P 500 up by about 0.3%, led by big tech and the NASDAQ 100. The bond market selling off, but to a lesser degree. Meanwhile, we do have some ISM services data coming in, missing expectations, coming in at 52 relative to expectations of 55.7. Let's get over to Mike McKee to break it down.
Yeah, I heard Matt groaning there, Katie, and there's reason to. We still see expansion on the services side, but it was a slower month last month as business activity fell to 53.7 from 57.2. New orders, 53.7 from 57.4. The employment index, 51.5 from 53. So that'll go into calculations for Friday's payrolls report. And, of course, the other thing that everybody looks at is prices paid, and prices paid basically unchanged, up just a tenth, 58.2 from 58.1. So overall, a slowdown in the economy on the services side, but not at this point a contraction, still a little bit of expansion there. We also had factory orders come out. They're up 0.2% after a 0.2 revised decline in September. Ex-transportation up just a tenth, so there's certainly a Boeing effect in there. The revisions to durable goods, we do see the headline number up 0.3 compared with 0.2 in the initial report, and the capital goods orders down 0.2. That's the same as we saw when this report first came out. So no real new information on the factory orders side, but we do see some slowdown on the services side.
All right, Mike, thanks very much. Michael McKee there breaking the ISM numbers for us. Of course, he just sat down with St. Louis Fed President Alberto Musalem, and I wonder if the market is still so sure that we're going to get a rate cut in December. I think the 18th is when we get those that decision. And if we continue to see rate cuts going on in 2025. Let's talk about that with Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. He joins us here on set at 7:31. Lex, Matt, great to have you in the studio with us. I'm sure you saw Mike's interview. We've seen a lot of Fed speak with Mary Daly, I think, saying, it's not a sure thing. Are we going to get another rate cut on December 18th?
It's a much closer call than the bond market is looking at right now. So the bond market's basically saying 70% probability of a cut. Our view is that it's more of a coin flip. The jobs report Friday is going to be huge because the last jobs report was 12,000 and really was hit by the hurricanes. If we get a nice comeback, the Fed might want to just pause. You know, if you look at next year, if they do just pause, I think it's going to be hawkish regardless. They've got to basically tell the bond market next year, don't be looking for a ton of cuts. And it would be good to get ahead of the reemergence of inflation. But you get the services ISM a bit weaker. That was the strongest part of the economy, was the services side. If that is weakening, that might give them a little bit of an odds of a cut. But right now, we're just looking at high-quality bonds, 5% yields, lock them in, and don't get whipsawed here day to day on some of these moves.
The whipsawing is an interesting point because if you looked at the pricing just yesterday, you had just over a 60% chance, really 62% chance starting the day of that December cut in the market.
Right.
You now a 74% chance.
Yeah.
Between yesterday and today, that pricing changed dramatically. Do you think traders could get really burned here as we're waiting for December 18th to come?
Yes. In the bond market right now, it is seeing as much volatility as a lot of other markets. The bonds aren't supposed to act like this. It's supposed to be more certainty. And I think all this Fed speak sometimes actually works against them because they're sitting here saying, you know, we're data dependent. When they're looking at every single data point. And as a bond investor, you don't want to do that. You don't want to overreact because then you're missing out on the yield. You're missing out on basically the lower volatility because you're adding volatility by trying to be too tactical. So we got more Fed speak. We've got Powell coming up. We've got a lot more data coming. But at the end of the day, the economy looks really strong. You know, I'm amazed every time at just how the economy is so resilient. And coming into the end of the year after the election, you've seen improvement in manufacturing surveys. That's going to help offset some of the weakness in services. And we would actually look for a pause. I think that would be better for the Fed going into next year.
Well, Matt, let's actually zoom out and let's get a little bit existential because you make an interesting point that bonds aren't supposed to behave like this. And if you think over the past several years, bonds haven't been acting like they should. They've been a terrible hedge. And I'm wondering if that's changed how you think about them in your portfolio, if they aren't acting as that traditional haven asset.
Yeah, I mean, someone might have said rates rule everything around me, or was it cash that was everything around me? I don't know which one it was.
Reem.
Yeah, right. Wu-Tang might have said that. But at the end of the day, that's what the market outlook is into next year because rates are going to be so powerful for stocks. If rates come up, the small cap rally fades, the bank rally likely fades because they need lower rates. And the PE ratios that have rallied, if you get lower rates next year, that's going to help multiples. But if they go higher, that's going to hurt stocks. And so for us, the bond market has never had so much control on the equity market as likely going into next year. But what we're seeing is there is some, the correlations are coming down some. Really into the election, after the election, bonds and stocks were getting more diversified. Look, if I came from another planet and just said, at the end of the day, the S&P's up 28%, how much would you think bonds are up? You know, if they're negatively correlated, they'd be down right now. At least they're up a couple percent. But for us next year, high quality bonds at 5%. If they go higher, we think that's going to cause weakness in equities. We want to be careful there. High quality income is a nice place to be into next year, though.
Well, I just want to follow up on that point. You know, this idea that rates have a lot of control over stocks right now. You could look at, you know, the chart of the 10-year yield, the chart of the S&P 500, and conclude that these two markets aren't even talking to each other. You have all this volatility in the bond market, and generally speaking, it just feels like the S&P 500 goes up and to the right.
Yeah, I mean, the trend has been a friend of many investors, but you got to be careful on momentum because when that is the number one factor, momentum right now. That it dominates the market, which basically means you chase performance. And if the 10-year goes above 450 to 5, I think the tune changes. So right now we're kind of in this in between. If we can stay at low 4s, high 3s, I think the stock market's happy with that. But if we go real low 3s, that's a recession signal. Above 4.5, that's the economy's overheating, and that's going to hurt stocks. So right now it's good. But if it goes above 450 into next year and the Fed says we're not cutting into next year, I think that's going to cause some weakness.
Is it only overheating that pushes us there? I mean, could we see the bond vigilantes come back, or is that a thing of the past?
No, I think it's a real risk. You know, I mean, we all are looking at like the next Liz Truss moment, and we're watching the UK bond market more than probably in the past, at least I didn't as much. But now it's just, you're like, oh my God, is this going to happen here? And for now, the dollar's being so strong. Like if the dollar was weakening right now and there was a real shakiness of confidence in the U.S. market and monetary policy, fiscal policy, the dollar be getting crushed. The dollar's strengthening. And that's another risk into next year, though. I'm really curious how earnings are going to come out for Q4 because the dollar is strengthening. 40% of revenues for the S&P are abroad. And those revenues are going to get trimmed right now because of a stronger dollar. There's a weight that comes with the crown of the king dollar. And so we've got to be careful with that, too. That's something we're watching next year.
Matt, I want to read something from your notes because I enjoyed it. It was, in a world of cryptocurrencies and duct tape bananas being sold for $6 million, you see relative value in high-quality U.S. stocks, large-cap, mid-cap stocks. You know, if you believe that quality is something like financials, right? Like a lot of people have, but you have a yield curve that at the beginning of the week was flat. I mean, isn't there risk in quality?
There is, but in terms of the earnings growth right now and the return on equity, the profit margins, the balance sheets, you know, we're going back to 2000. Every time we look at the P ratio, we're like, okay, 24 times is the peak in 2000, we're at 22. All right, you know, but then we look at the quality stocks relative to 2000, they're throwing off a ton of cash. They've got hundreds of billions in cash on the balance sheet. So it's much different place than 2000 on that front. Quality, at least you're getting earnings that are growing. Mid-cap earnings are down. Small-cap earnings are down. The large-cap, high-quality stocks, their earnings are up. They're up about 6%. And we'll take it in a world like this where there is some crazy stuff going on with duct tape bananas selling for $6 million.
And then being eaten.
Right?
You know?
Delicious.
He ate that.
I wonder if it
Was it
tasted
brown?
worth $6.2 million. I can't imagine.
No, but it
Yeah.
must have been very ripe, right?
It's true. Matt, it's great to see you in person. Come back soon. That is Matt Miskin of John Hancock Investment Management. Now, coming up, we'll speak with the Travel and Leisure CEO, Mike Brown, after one of the busiest weekends for travel in history. This is Bloomberg.
Let's get out of high interest. Look at what's making headlines around the world. Salesforce reporting quarterly revenue that topped analyst estimates, boosting investor hopes that AI will drive long-term strength there. The company pivoted its strategy this year to focus on AI tools, agents that would provide customer support without human supervision. And Bloomberg has learned that the $60 billion proposed management buyout of Seven & i will include plans to IPO its U.S. assets. The move is intended to help ease financial concerns. Seven & i intends to retain a stake after any potential listing. JetBlue is boosting its forecasts for the fourth quarter. The airline posting higher than expected bookings in November and December and said costs were declining thanks to falling fuel prices. Under its new CEO, JetBlue said it hopes to reduce expenses and boost sales and will pull back to core markets in the Northeast and Southeast after a failed expansion. Katie?
Well, Matt, on that topic, last weekend was one of the busiest for travel on record, and demand remains high with Americans continuing to seek out more deals on Travel Tuesday, one of those days that we're learning about. Joining us now is the CEO of Travel and Leisure, Mike Brown, joining us in person at the desk. Great to see you.
It's good to be back.
So it feels like there's a really uneven consumer right now because you take a look at Foot Locker results, Foot Locker flagging some weakness heading into the holidays, and then you have JetBlue, on the other hand, lifting their revenue outlook. When it comes to the state of the consumer as you see it and demand for vacations, what's the view right now?
We've ultimately seen a stabilization and even a greater confidence from the consumer in the last 30 days. We get a lot of questions, was it the election? But you bring together a few factors that we're seeing, which is a market that's at an all-time high, clarity around where interest rates are going, and maybe certainty around the future, obviously, of the election. All that seems to be giving confidence to the consumer, and we've seen a lot of confidence in the fourth quarter with our owners who are buying more of our product and getting on vacation on a regular basis, which I think we just saw this past weekend with record flights and record travel for the Thanksgiving weekend.
It's interesting because if you look across the industry, take a look at your stock, for example. It's up almost 40% this year. And you are seeing a lot of investors really dive into the idea of travel and leisure. But, you know, you think about where people are going. How much are they willing to shell out? Is it the big bucks that they're willing to spend on experiences, or do they want to kind of stay kind of local, take those couple days off and, you know, spend a little less given where we are right now?
Well, we have one very clear measure that we look at when times are positive and when people are being a little more cautious. Our consumer continues to go on vacation in either environment, but what we see is people pull back and they'll go to more drive-to destinations. We're not seeing that. We're seeing as many people on that mid to long haul vacation as we saw earlier in the year. And secondarily is the length of stay. We're seeing our length of stay extend, which is a combination of confidence, but also this work from anywhere environment. We're seeing people work at our resorts, which have 1,200 square feet per unit.
Sounds nice.
Do they have any TV studios? That would be great.
Maybe a new brand and a new segment for us in 25.
Yeah, I know a lot more people now interested in your model.
Yes.
Women and men on the street. But I wonder, global warming became passé and we started calling it climate change. ESG, in Wall Street now is called transition finance. Have you thought about a rebranding of the word timeshare? Because it still feels very like 1980s to me.
It may feel that way, but let's look at how this industry has dramatically changed. If someone were to say to you, when you checked in at your favorite hotel brand, I'm going to upgrade you to a 2-bedroom suite, that's what our business is. 80% of this industry now are branded hospitality companies. Wyndham, Accor, Margaritaville, Hilton, Marriott, Disney Holiday Inn. The 80s that you're talking about, that was purely independent companies, single site real estate developers. We have 280 resorts around the world that hospitality, loyal, committed consumers are vacationing in. And when they don't want to go to one of our resorts and enjoy 1,200 square feet on their vacation, they can exchange it and go to one of those hotel rooms. So sure, there's work we need to do on maybe naming and educating, but fundamentally the macro trend is I want more space when I travel, I want a brand I can trust, and I want amenities that, while I've had a long day at Disney maybe, the kids, when we get back, can go down to the pool while I enjoy a glass of wine in my 1,200 square foot apartment.
Well, let's look into 2025.
Yes.
Sonali brought up the share price, up 40% year to date. What is going to happen in 2025 when it comes to growth expansion that could keep the momentum going?
Well, obviously, equity will take care of itself if underlying operating business runs well. I think what you've seen in our equity this year is a recognition that we've consistently delivered, raised our guidance, and returned significant amount of our cash flow to shareholders through the form of a dividend. And we'll probably take out 7 to 8% of our shares this year after 10% last year. All that's possible with a great underlying business model, and we expect top line to continue to grow in our core vacation ownership business. And we've also announced the acquisition of Accor Vacation Club, the launch of Sports Illustrated as well. And all of those just give us more opportunity to provide what we believe is the reality of how people want to travel today. They're becoming more niche to attach their vacation lifestyle with their personal lifestyle. So Sports Illustrated, our first announcement was in Tuscaloosa, Alabama. Some Alabama alumni, I think they're going to be fans of that and be interested. So we have new veins of growth through new brands and attaching lifestyle to the way people vacation.
Mike, thanks for traveling over here. I know you guys can't stand my jokes, but appreciate it today.
We love them, Sonali.
Half the time. Anyways, vice versa. Anyways, coming up, France is on the edge. The country is likely to be brought down by a no confidence vote. A lot going on across the pond. We're going to bring you the latest on the political turmoil. This is Bloomberg.
Appauvrir les plus pauvres pour enrichir les plus riches. Tout y est dans ce plan d'austérité de fin d'année.
Now, France is poised to hold a no-confidence vote that could topple the government. Joining us now for more is Bloomberg's Caroline Conant, who joins us outside the National Assembly in Paris. Talk through what to expect as we watch this vote continue.
The debates have already started at the National Assembly right behind me. 2 motions of no confidence against the current Prime Minister, Michel Barnier. We're going to have the result of this vote in the next couple of hours. But technically, there's very little chance that this Barnier government is going to survive the night. They are leaving their last few hours. So Michel Barnier could be the shortest-lived Prime Minister of the Fifth Republic since 1958. Only 3 months in power. And next, President Macron is going to have to name a new prime minister, hopefully quicker than last time. It took him 2 months after the snap elections in July.
Caroline, it's interesting to see the left, the far left, and the far right get together to support this motion of no confidence. Is there anything else on which they agree? I mean, could we see any progress with those 2 combining forces, or is it just that they don't like Barnier?
It's actually a very interesting question. In fact, President Macron, who is coming back as we speak from a trip to Saudi Arabia, he was on a state visit, he's going to come back tonight, was actually saying that the far right and the far left joining forces together, trying to topple this government is a fact of unbearable cynicism. And clearly that's the case. The first time we've ever seen that, those 2 extremes joining forces. Now, what's coming next? Is there any hope for another prime minister, for whoever is named next? Well, it kind of depends on the far left. At the moment, they have this alliance with the socialists. Are the socialists, center-left, going to break up from the far left to possibly join some kind of center majority? We'll see exactly what's going on. But this is clearly something that is very unheard of. We are entering uncharted territory here.
It's also moving quite quickly. Of course, put this into context here on how President Macron is handling the issue right now. We know that he had earlier asked the lawmakers to set aside personal ambitions.
Yes, that's right. And of course, Marine Le Pen, as you know, has her eyes on the bigger prize, which is 2027, the next presidential elections. And what's interesting in the short term is that she is facing a potential ban from running for office for 5 years in this trial on alleged embezzlement of EU public funds. So she's going to have the verdict on this trial at the end of March. And a lot of opposition parties here are actually saying she has not been behaving rationally since the prosecutors requested this ban from office. So perhaps in the short term, she prefers chaos to stability.
All right, and we're certainly getting some chaos right now. Appreciate your reporting on the ground. That is Bloomberg's Caroline Conant in Paris. And you can follow along with the vote in real time on TLive on your Bloomberg terminal. Meanwhile, let's get a check on these U.S. markets. About an hour into the trading day, you have the S&P 500 up by about 0.3%. That would be good for a new record high. I think that's the 55th, right, if we close green today?
No, today would be the 56th.
The 56th record high, potentially, on the S&P 500.
And it would be a 27% gain.
That would be huge.
So far year to date.
Is that total return?
No.
I must say also, you've got to love today that the trade is really right back to the AI trade. So much for the small caps.
Yeah, the big tech in charge right now, the NASDAQ 100. But small caps, they're fighting. And, of course, they've been the outperformer. So we'll see, though, if the Fed does back up.
It's fun to watch you fight for them, Katie.
Yeah.
I just think it's fun.
The biggest proponent of the Russell 2000 right here on our desk.
You got to root for the little guy. Anyway, Lamborghini up next. Stefan Winkelmann.
Yeah, I'm looking forward to it. Stefan Winkelmann coming up. Lamborghini making new records in deliveries, sales, and operating profit. This is Bloomberg. So Jaguar isn't the only car maker showing off automotive artwork this week. Lamborghini is debuting a Miami-inspired version of its hybrid SUV, the Urus. during the International Art Basel Fair in southern Florida. The Italian supercar unit of Volkswagen has posted its best first 9 months ever in terms of deliveries, revenue, and operating profit. And joining us now from Miami is the CEO of Lamborghini, Stefan Winkelmann. Stefan, thanks so much for your time today. Talk to me first about, your results are another record now in 2024, and I imagine that just continues through the end of the year. Are you going to post the best year you ever have?
But so far, it seems like it. It seems that we are going to be, again, on a record high, as you said, now in terms of deliveries, in terms of operating profit, and also for sure in terms of turnover. What we're always looking into is not running for the peaks. We are looking into the fact that we need to have a solid order bank, which should last between 1 and 1.5 years. And this is paramount for the success also for the year 2025. And also, on the other hand, we have good or very high residual values, which is now giving us the peace of mind that the things are going into the right direction. And last but not least is the fact that we have a balanced distribution over the major regions in this world. And not to forget that now we have the youngest lineup in terms of products we have ever had in the history of Lamborghini, and also, in my opinion, the best one.
Yeah, you are sold out, I think, at least until the end of 2026, so I can't buy a new Lamborghini. That's part of the reason why prices in the aftermarket are even higher than MSRP. Are you planning a fourth model? You've previously shown the Asteria concept, PHEV. It paves the way for a front-engine competitor to Ferrari's GT vehicles. Is that on the cards?
But our idea is to have the 3 cars we have today as plug-in hybrids, which is the first step of our strategy we call Portauri. So to have more performance by less CO2 emissions. And by the end of this decade, we are looking into a 4th model, which we showed already as a concept car last year in Pebble Beach, the Lanzador. And this is something which is going to happen by the end of this decade and will be the first full electric car. And I think as an add-on, this could be a good step for us in terms of closing the circle, because a GT car, this is what it is now, an elevated GT car, so a 2-door 2+2, is what is missing today in the lineup of Lamborghini.
Really curious about how you would categorize what's happening with hybrids right now. If you think about the demand moving forward, how much of it is coming from the U.S.? How excited are U.S. consumers? Where is the hesitancy? To what extent do you believe that this could be the model of the future?
I think we are very well positioned with the plug-in hybrids. The important thing is that you have to keep the promise, being us a car manufacturer which is not selling mobility but dreams. On one hand side, the design has always to be new. We have cutting-edge technology, and we have to keep the promise that this generation is more performing than the generation before. And at the same time, we are emitting less CO2 emissions. If this comes together, and this is happening, then the customers buy in, and this is equally distributed into the regions of the world. And we are very carefully looking into it. And the US is by far the biggest market we have. And now I'm here in southern Florida, and Florida is the second largest in the US. So it's important to be here as often as we can.
Being the biggest market that you have, I wonder how you're preparing for looming tariffs. I realize that your product is at a price level which makes buyers maybe slightly less elastic, but are you importing, for example, more cars now to get in under the wire? Did people make more purchase decisions post-election due to the certainty?
No, we are doing business as we know it. We are for a free trade world, and we are not, let's say, doing speculations about the future. We do our job, and we are here to stay.
Speaking of challenges, I also want to talk about your parent company because, of course, Volkswagen is pushing for factory closures, wage cuts, layoffs in Germany to improve profitability. How will the cuts impact you and the synergies that you enjoy with Volkswagen?
But you know, the Volkswagen Group is very good in dealing with brands. So we have our responsibility in terms of for sure, the operating profit. We have our responsibility of research and development, producing cars, and also selling cars. So there is no effect or no negative effect on our plans for the future in the Volkswagen Group.
All right, Stefan, we really appreciate your time. Very exciting to see the products that you're putting out, and I'm hopeful that we'll hear more about a 2+2 model in the future. Stefan Winkelmann there, the CEO of Lamborghini. Let's take a look at what's going on in these markets as we, at least for now, are up and looking at the potential for another record high on the S&P 500. That can't help, or can't hurt, I should say, Lamborghini sales. Right now, the S&P 500 is pushing over 6,060. If you take a look at the boards, you'll see it's 6,072. Let's get over to Bloomberg's Abigail Doolittle for the details. Abby?
Yes, indeed, Matt. There it is, 6,072, up more than 0.3%, on pace for yet another record high, up a fourth day in a row. And that's true, too, for the NASDAQ 100 and the SOX, up 4 days in a row. But you can see the strength really is for these big tech indexes, the SOX in particular, up 1.6%. Its best day in more than 2 weeks. What's so interesting here, though, is if we take a look at the momentum for tech stocks by taking a look at the RSI on the NASDAQ 100, this is just the RSI without the index over the last year. You can see last December, take a look at how sky high it was, well above 70. At that point, though, it was declining. So that was telling you that that momentum was coming off. Well, it's really been coming off over the last year. Just today, we're starting to break the trend of a lower high, but we're still below 70. So this suggests maybe these bulls are going to break out a little bit, but again, well below where it's been before, telling you that the buying we're seeing these record highs, there's a bit of a bearish divergence there because the momentum is not quite as strong. Where the momentum is clearly, though, some of the tech stocks that are doing well today, including Marvell Technology, right now up a whopping 22%, the best day since March of 2023. They beat, they boosted. AI demand really helping. AI demand helping CRM, Salesforce.com, as well. A record high there for that stock, up 9.2%, the best day since November of 2023. And numbers considered to be good all around. Nike, on the other hand, falling in sympathy with that quarter out of Foot Locker. Actually, I should say the outlook for Foot Locker, talking about this holiday season really being a little bit pared back from expectations and bringing down the overall full year, fiscal year 2025 comp view to below the estimate, taking away the high end of the range. So Nike down, and one analyst saying that Foot Locker guide is really of concern. And then finally, Chewy down 7.8%. Interestingly, Katie, they beat, they boosted, but the EBITDA view not quite as strong as some analysts would have liked it to be.
All right, Abigail Doolittle, appreciate that roundup. Now, coming up, Eli Lilly says that its weight loss drug outperforms its rival from Novo Nordisk. We'll talk to Eli Lilly's chief scientific officer just ahead. This is Bloomberg. Time now for our daily Wall Street Week conversation. And homeowners aren't the only ones paying more to protect their property. Insurance for insurance companies is also rising. David Weston spoke with Swiss Re US and Casualty CEO Monica Ningen about reinsurance and how consumers can mitigate their own risk.
Yeah, I think most consumers understand that your risk premium relates to the exposure that you have. So if you insure a car that is worth $5,000, it's going to be a very different auto premium than if you insure a car that's $120,000. Most consumers understand that. And that's true for insurance and for reinsurance. So we take a look at not only what we're insuring, but where we're insuring it from a reinsurance standpoint, and that's built into our rates.
In your experience, does that suggest that there may be some places that are not insurable? Now, obviously, that doesn't apply to reinsurance. I'm talking about the insurance companies now. But everything can be assured at a price, but the price may be prohibitive.
Yeah, so by and large, we believe that insurability will exist going forward. Insurance does rely on the fact that it is not a risk that happens every single year. So there needs to be some unpredictability for it to be insurable. If it's a situation where something is damaged every year, then something like pre-financing becomes a better mechanism than insurance. There are also many other important things to think about before you get to lacking insurance, which is around mitigation. Mitigation is a really important part of this equation as you look from the consumer and having a resilient community and a resilient home. Mitigation comes into play. And if we get to the fact that something is not insurable, a lot of times you end up in a situation where relocation becomes the ultimate outcome, which is unfortunate to communities and families, but sometimes is a situation, if you have something that's flooded repeatedly over and over again, sometimes you have to result to relocation.
As you look at the risk that you're reinsuring, do you see a change in the behavior of Americans, at least in some places? The mitigation you're talking about, which I'd say could be either where you build, where you live, or how you build, what you do with respect to code compliance and protecting your home.
We do. It's slow, and I think a lot of consumers don't necessarily understand the importance of mitigation or just taking care of your home. One of the things that I often ask my friends is, the quality of their roof. It's not a very popular conversation at dinner. Most people want to talk about either their kitchen counters or, what they're doing to revamp their bathroom. It's not very often that people want to talk about the quality of their roof because it's just not very fun. But consumers are starting to think about that more and more, especially in locations that are repeatedly hit by catastrophes.
That was Monica Ningen speaking with David Westin. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. Now, coming up, the results are in from the latest trial of weight loss drugs. Specifically, we're talking about the first head-to-head trial of Zepbound versus Wegovy. We'll speak with Eli Lilly's chief scientific officer next. This is Bloomberg. Well, Eli Lilly's weight loss drug Zepbound outperformed Novo Nordisk's in the first head-to-head trial sponsored by Lilly. Patients were found to lose an average of 20% of their body weight compared to 14% with Wegovy. Let's discuss all of this now with Dan Skovronsky. He is Eli Lilly's chief scientific officer, also the president of Lilly Research Laboratories. Great to have you with us. You take a look at some of the reaction to these numbers. Bloomberg Intelligence writes that this results will be beneficial from a marketing perspective once they're on the label. Is the plan now to submit this to the regulators to get this on label?
Yeah, thanks for the question. Thanks for having me on the show. We're so thrilled by this data. As you pointed out, the first ever head-to-head study, 50 pounds weight loss on average for Zepbound versus 33 for Wegovy. I think that's important information. It's actually probably the most common question we get from patients and doctors is I've heard there's these two different weight loss drugs. How do they compare? And so this is great data. And I think, as you're pointing out, the next steps are to talk to regulators, understand how we can use this and communicate this to doctors in the best way.
Well, let's talk about some of these numbers. So patients treated with Zepbound lost an average of 20% of their body weight over 72 weeks. Those who got Wegovy shed 14%. And I thought that was interesting because usually it's 15% weight loss for Wegovy. So why did it come in on the lower end?
Yeah, I think these numbers are pretty consistent with other studies. This was a US-based study where other studies have been global-based studies. So there could be slight differences here and in terms of the population that was enrolled. But overall, the numbers for both tirzepatide, Zepbound, and semaglutide, Wegovy, were very similar with their published previous studies of each one alone. But what's important is this is the first time they were studied in this head-to-head way where patients were randomized to get one or the other.
Dan, as I understand, you are not just the chief scientific officer, but also an actual medical doctor.
Yes.
It's not just about weight loss for patients, right? It's also about keeping side effects as reduced as possible. There are other benefits to these drugs. Hopefully, reduces your risk of heart attacks. Also, maybe can reduce your risk of dementia in some ways. What's the more holistic picture about how your drug affected patients in this trial?
Yeah, absolutely. And thanks for pointing that out. Maybe just starting with side effects. This medication, Zepbound, has side effects. Most common side effects are related to GI tolerability. We were pleased with the data we saw. They were consistent with prior studies, which showed that this drug is actually highly tolerated by most people, and nearly everyone can stay on the drug and complete the trial. The other side of the coin are the myriad of benefits that could accrue as a consequence of weight loss. Just in the last year or so, we've read out studies on this medicine for patients with obstructive sleep apnea, where we showed that about half of the patients actually didn't even meet criteria for apnea at the end of the study. That's how much their disease improved. For heart failure, where we showed a 38% reduction in heart failure events for people on this medicine. And then most recently, and I think it was just astounding data, as we studied Zepbound in people who have pre-diabetes. They don't have diabetes yet, but they look like they'll go on to get it. And about 20% of patients on the placebo went on to get type 2 diabetes in the course of the trial. And nearly no one, actually, a 94% reduction in the incidence of type 2 diabetes on people who are on Zepbound. So all these kinds of studies show that losing weight and treating obesity can actually prevent or improve a number of other serious chronic diseases.
I'd love to go back to the competitive landscape here for a minute, because of course this study did show a significant differential, but the next catalyst that investors are looking out for also is when it comes to Novo Nordisk's CagriSema, and there's an expectation there of a 25% weight loss, and the data is due by year end. You know, how do you see that challenge playing out in terms of competitive positioning?
Yeah, let's see. I think it's a really great dynamic for patients and society here. Novo had the first monotherapy for obesity here. We had the first dual-acting GLP, GIP combined medicine here, which showed superiority today. But Novo now comes out with their own combination of two different actions here, GLP and cagrilintide. We haven't seen the data yet, so we'll have to wait and see how they do. And then Lilly, guess what? We have a triple-acting molecule now that's in phase 3 trial called retatrutide that combines 3 different incretins. And we'll look forward to getting that data in coming years. But what we're seeing, I think, is a breakthrough in the science that's allowing us to create more and more powerful medicines, to the point where I hope most people with obesity will be able to get to a normal body weight with these medicines. Actually, in this trial, we saw a significant fraction of patients, almost a third of them on Zepbound, had 25% weight loss. That's just a life-changing number, and it was twice as likely to happen on Zepbound as on Wegovy in this trial.
Well, first of all, Dan, you make a great point. We talk about this race between Eli Lilly, this rivalship with Novo Nordisk. The ultimate winner is patients in this scenario. And you mentioned, of course, that larger trial that you're conducting for retatrutide right now. In a smaller trial, I believe, smaller study, it delivered 24% weight loss. What are your expectations from this larger study when it comes to weight loss?
Yeah, I don't know yet, but in that study, it was actually a shorter duration. It was less than a year. And at the end of the study, people were still losing weight. So I'm hopeful that in a larger study, a longer study, we could see even more, maybe get close to 30% body weight. These are levels of weight reduction, though, that are very comparable to what's been seen with bariatric surgery, which, although is obviously invasive and costly and dangerous procedure, but still many people benefit from bariatric surgery. And so to be able to offer that in a medicine is really a dream, and we're so excited by that.
Well, I mean, at a certain point, it becomes kind of a ridiculous arms race, right? I mean, do we lose 70% of our body weight? Isn't there a point where you work on other things besides reducing bigger and bigger percentages of your weight until somebody loses like 100%?
Yeah, no, it's a good point. Of course, it's not an arms race. We're not making weapons of mass destruction here. We're making medicines that make people feel better. But you're right, there's diminishing returns at some point, and I think we're reaching that point soon. These medicines are strong enough that most people will be able to achieve a normal body weight. So what else can we offer patients as we continue to try and out-innovate each other to make better and better medicines? I would say one idea is oral. Many people prefer to take something in a pill than an injection. And so we have a pill coming. It's in phase 3 clinical trials. We're going to get the data next year. And we hope that it could give efficacy similar to GLP-1 monotherapy, maybe not quite as good as Zepbound. It's a single-acting incretin, but it should be a really easy-to-use pill that's widely available. So we're super excited about that.
Well, Dan, let's stay in touch. We would love to speak to you again, of course, when those results come out. That is Dan Skowronski of Eli Lilly. Meanwhile, we quickly check on markets here. It is a green day on Wall Street. The S&P 500 up about 0.3%. Big tech is your leader right now. The Nasdaq 100 building on its momentum, up about 0.9%. Even the bond market taking back its losses. Yields now a little bit lower on the day. We're looking at 420 once again on your 10-year yield, Matt Miller.
Yeah, very interesting stuff there. Coming up tomorrow on Open Interest, more interesting stuff. Jay Hatfield joins us from Infrastructure Capital Management, and Stephanie Drescher, Apollo Chief Client and Product Development Officer. Come back tomorrow. This is Bloomberg.